A very good day to all of you. Today we'll be revising Ind AS 105 non-current assets held for sale and discontinued operations. It's a relatively smaller and easier standard, right? So as usual, the objective of the series is to give you a pilot view of the entire standard. And for this purpose, we have divided the various principles of the standard as concepts so that it's easier for you doing your self-revision. So without any further delay, let's get into the revision of the standard. So I have divided the standard into two parts, and in the part one, we'll be dealing with not current assets held for sale, and the part two, discontinued operations, right? So let's begin with the part one. The first most important thing to understand is the scope of the standard, right? What is the scope of the standard in this 105? In case an entity wants to recover the value of an asset, not by continuing its use and by sale, in that case, this standard will come into use, right? When will the standard come into use? When the entity wants to recover the value of that asset, not by using the asset, but by selling it and recovering the amount. That is when the standard 105 held for sale will come into play, right? Some important definitions that you need to learn in this chapter. First is, what are non-current assets classified as held for sale? Is nothing but, again, the same thing. If its carrying amount will be recovered by selling rather than by the continuous use. So in case I want to recover the carrying amount of the asset by selling the asset rather than using it in my operations, then I will call it as non-current assets held for sale. Such non-current assets will be classified under Ind AS 105 as non-current assets held for sale. Now, what a disposal group? What are disposal group is the next definition. So disposal groups are groups of assets and liabilities which are directly associated with those assets to be disposed of by sale. Right now, when I say non-current assets, it's only a single asset. But when you talk about disposal group, it is a group of assets and liabilities that is associated with that asset that you are planning to sell. And together as a group, they are a single transaction. They'll be sold as one. Together as a group, they'll be sold as one. This disposal group can be a separate CGU also. What is CGU? A cash generating unit, right? This disposal group can be a CGU also. It can be a group of CGUs or a part of a CGU, right? It can be a separate cash generating unit as such, or it can be a part of a cash generating unit, or it can be a group of cash generating units, right? So disposal groups are nothing but disposal group are groups of assets and liabilities that are associated with the original asset that is going to be sold, right? I hope this definition is also clear, and the scope also we have covered. Now, classification of non-current assets as disposal as held for sale. Two conditions need to be satisfied. How many conditions need to be satisfied? Two conditions needs to be satisfied. The first condition says that available for immediate sale in the present condition. It should be available for immediate sale in the present condition, and sale must be highly probable. Sale must be highly probable. What are the two conditions to classify an asset as non-current asset held for sale? First condition is it should be available for immediate sale in the present condition, and sale must be highly probable. The sale must be highly probable. Now let's see some important things related to that. Both this condition. The first condition says what? Available for immediate sale in its present condition. Now, the first point that you need to understand is if there is any terms which is customary or useful to the sale, if there are any terms which is customary or useful for the sale, then in that case, because of that term, you will not disqualify this asset as non-current asset held for sale. You will not disqualify this asset as non-current asset held for sale. Let me give you a small example to get a better understanding. In case you need a regulatory approval, right? You have a disposal asset, and to sell that you need a regulatory approval. Now, getting this regulatory approval is customary, right? Obviously, you have to get the approval from the government officials in order for the sale to happen. Now, this is very much customary and this is very usual in such a transaction. So, in that case, because you have not received the regulatory approval, does not mean you will not qualify this, right? So, it does not mean that it is not available for immediate sale in the present condition. It is. So, in case there are some terms which are usual or customary to the sale, in that case, because of the existence of those terms, you will not disqualify that particular non-current asset or disposal group as not being held for sale, right? So that is the first condition. Second condition is saying it is not considered as it is for immediate sale in case of the following condition. If the entity is intending to sell it, but not in the near future, it is intending to sell it in a distant future. In a distant future, it is planning to sell it, not in the immediate future. Then you will not classify this as non-current assets held for sale. And the asset is vital for the entity's ongoing operation. So if the asset is being sold out, or if the asset is put for sale, then the entity's operations will get hindered, right? So in that case, the entity's vital operations are going to be affected because of this asset being classified as held for sale, then it will not be classified under Ind AS 105. Asset is being refurbished. What do you mean by refurbished? Renovated. The asset is being renovated, or changes are being made to the asset. So in that case also, you will not classify them as 105. Why? Because the first condition of 105 is not satisfied. What is the first condition of 105? It should be available for immediate sale in the present condition, right? So any of these three cases exist, you will not consider the asset to be for immediate sale in the present condition. Hence, the classification under Ind AS 105 will not happen, is what the standard says. Right? And the second condition was that the sale should be highly probable. Sale should be highly probable. What do you mean by highly probable? The probability of it not happening, not occurring, is very much less than the probability of it occurring. The probability of it occurring is higher. It is much more than the probability of it not occurring, right? So for that, they say that 5 conditions must be satisfied. And remember, all these 5 must be satisfied. All the 5 must be satisfied, right? Now let's see what are the 5 conditions. The first condition says that management must be committed to sell, right? The management must not be, it must be committed, right? It should not just simply for the sake of it. No, you must be committed. The management should have taken the steps to initiate the sale of that particular non-current asset. The second says that an active program for tracing a buyer must be initiated. Obviously, you want to sell an asset, you need to buy a suitable buyer, right? Now, not the you have decided that you want to sell this particular non-current asset. How will the other parties come to know, right? You have to advertise, you have to inform people, you have to market it. So such initiatives should have been taken by the organization. So the management should have an active program for tracing a buyer for this particular non-current asset that you are planning to sell. The asset must be marked for sale at a reasonable price. Exactly. It should be marked at sale for a reasonable price, right? Let's say this particular asset can be sold in the market. The market price right now, and in which all the others are selling, is, let's say, around 1 crore. So if you're quoting it at 5 crores, your particular non-current asset, you're quoting it at 5 crores, are people going to buy it? Obviously no. Then obviously that clearly means that your intention is not to sell. Because if your intention was to sell, why would you keep a price that is greater than the market price? Because if you keep a price greater than the market price, obviously the prospective buyers are not going to come to you. So the rate or the price that you are going to set for that particular non-current asset that to be sold must be reasonable. And the sale should be expected to be completed within a time span of 1 year. And the sale should be expected to be completed within a time span of 1 year of classifying it under Ind AS 105. Next is, any significant changes to plan to sell are very unlikely. Unlikely means it is not, probability of it not happening, right, is very, very high. You are not going to have any plans of changing it. Now you have classified as held for sale. Now changing that intention should be highly unlikely. So in case these 5 conditions are satisfied, then you will tell this that the sale is highly probable. What are the 5 conditions? The first condition says that the management must be very much committed to selling that particular non-current asset. Active program should have been initiated for finding a suitable buyer for this particular non-current asset, and the asset should be marked at a reasonable price compared to the market. Sale is expected to be completed within a span of 1 year from the time of classification. And the fifth point says that any significant changes of changing the intention to sell are very much unlikely. Changing the intention to sell that particular non-current asset are very much unlikely, right? So these are the important points. These are the 2 important points when that comes to classification. So when you will classify an asset as held for sale, first condition, it should be available for immediate sale in the present condition, and second condition should be sale must be highly probable. And the specific points under them we have discussed here in our notes, right? Now come to some other important points that we need to discuss. The first being plan which involves loss of control in subsidiary. In case you're planning to, sell your entire subsidiary itself. At that situation, all the assets as well as the liabilities of that particular subsidiary will be classified as held for sale. All the liabilities and all the assets of that particular subsidiary will be classified as held for sale. This is in case an entire subsidiary is being put as held for sale. In case an entire subsidiary is being put as held for sale. The second point is that if after classification you have classified, and when we classified, we studied one condition: if the sale should be highly probable, there was one point that said that the duration for it to be sold should be 1 year within the date of classification. Now this point says that 1 year has lapsed, but still you are not able to make the sale. 1 year has lapsed. If after classification 1 year has lapsed, entity can still classify it as held for sale if the delay is beyond the control of the entity. If the entity had no control over the delay, right? It was not because of the entity. An entity do not have any direct control over the delay, and if there are sufficient evidence that the entity is still committed to sell this particular non-current asset, you can classify that as held for sale. So what does the second point say? It says the standard initially says that after classification under IND AS 105, within a span of 1 year, right, after classification, you should have sold that asset. But 1 year has lapsed, but I'm still not able to sell the asset. But the delay that is happening is not because of me. The delay is beyond the control of the entity, and sufficient evidences which says that the entity is of the intention of selling this asset. In that case, the asset can be classified under IND AS 105, right? Next, this is an important point. If the buyer, if the person who's going to buy that particular non-current asset does an inspection, and during the inspection he identifies some environmental damage not previously known to the selling entity. So the seller also did not know something like this existed, but during the testing or during the inspection, the buyer has come across some environmental damage, then it can be held for sale if the entity will make good the damage and the sale is highly probable. Then what does the standard say? Because the seller also did not know such a damage is existing, right? So intentionally he did not hide the fact, even he was unaware of it, and later during the buyer's inspection you come to know about it, and the seller agrees to make good the damages and the sale is highly probable, then you can classify that asset as held for sale. Then you can classify that asset as held for sale, right? I hope the 3 points are very much clear. Now let's come to the next point, which says in case the asset is acquired exclusively for subsequent disposal. The purpose of acquiring that asset was to subsequently dispose it, but does not meet the immediate sale condition at the time of acquisition. Like when you bought it, some minor changes have to be made. So immediately is that available for sale? No. But did you purchase this asset with the intention to sell it? Yes. So it was acquired with an intention for subsequent disposal. But when it was acquired on the date of acquisition, what was not satisfied? The immediate sale condition was not satisfied. Let's say it is going to take 3 months. Some renovation or some work needs to be done on that, and that's going to take 3 months. Now, under which standard will you classify this? Will it come under 16? Or will it come under 40, or now will it be classified under 105? Because to classify under 105, the classification criteria that we had read earlier, if you see here, says the first condition itself is that it should be available for immediate sale in the present condition, which is not being satisfied. So now the standard is asking how we should classify. Should we classify it as under 16, 40 or 105? The standard clearly says classify it under 105. The standard clearly says classify it under 105. If the entity can meet the immediate sale condition within 3 months, if the entity is able to meet it within 3 months, then it can be classified as held for sale on the date of acquisition itself, right? Immediately, yes, it is not held for sale, but within 3 months, the entity is sure that it will come to the condition of held for sale, and the asset was acquired with the intention for subsequent disposal. Then if the condition can be met within 3 months, you can classify it as held for sale. Now, let's say if the condition is going to be met only after 7 months, then you have no other option. You need to classify it either under 16 or 40 or whatever is the respective standard, right? You cannot classify it under IND AS 105 is what the standard says, right? Look at the next condition. Criteria meeting after the balance sheet date. You are meeting this criteria after the balance sheet date, but before the approval of the financials. Then it will be treated as non-adjusting event, and only disclosure is required to be given in the notes, right? If the condition is being met after the balance sheet date, but before the finalization approval of the financials, still the standard says it will be considered as a non-adjusting event and only the disclosure is required in the notes, right? Next point. In case there's a non-current asset or there's a disposal group that need to be abandoned or ceases to use, then under which it's abandoned or you're ceasing its use, it's not going to be used anymore. So in that case, what you will do, but is expected to be bought back to use, not classified as held for sale because its carrying amount will be recovered through continuous use. So let me explain the situation to you. There is a non-current asset or there's a disposal group, right? Currently, okay, its use has been seized or abandoned, let's say because of COVID. A lot of plant and machineries were there, right? In your factory, let's say a lot of plant and machineries were there. But because of COVID, you were not having access to go to the factory and run those machineries. So presently, for the time being, that use were abandoned or seized. But you are expecting to use it in the future. Obviously, after COVID, I'll go back to my factory, I'll run my machineries, right? So I'm expecting to be used after some period. So will that be classified as held for sale? The standard says no. Because when we discussed in scope 105, you will classify a non-current asset only when your intention from that asset is not to recover its value by use but by sale. But here, if you look at this situation, you are expecting to recover the value of the asset by sale, not now. Now the use has been ceased, but in the near future, yes, in the later future, you're going to be using it and recover its carrying amount. So in that case, you will not classify such an asset under IND AS 105. The standard very clearly says, in case there's a non-current asset whose use has been currently seized or abandoned, but it is expected to be used in future, then it will not be classified under IND AS 105. Then it will not be classified under IND AS 105, right? Next, come to the measurement criteria. Okay, for non-current assets or disposal group, the standard says the measurement will be lower of either the carrying amount or the fair value less cost to sell, or the fair value less cost to sell. Lower of the carrying amount or the fair value less cost to sell. And in case there's any loss that comes in remeasurement, when you're calculating the fair value and you're comparing, if comparing that with the carrying amount, there's any loss that comes, that will be included in the P&L of the continuing operations. You will have the continuing operations, right? These are the non-current assets or the disposal groups. You will obviously have the other operations, continuing operations. So in that P&L, you will be booking this particular loss. And once the asset is being classified as held for sale, no amortization or depreciation will be, charged to such assets. So depreciation and amortization, of course, when we have discussed in IND AS 16 and also in IND AS 40 and in IND AS 38 intangibles, everywhere I mentioned that moment it is classified under IND AS 105 held for sale, in case it was derecognized, there if I would want to recall the principle, it was that if it is being classified as held for sale or if it is derecognized, your depreciation will cease, right? The same point is being repeated here also. In case once it's classified under 105, the depreciation and amortization for that particular asset will cease, right? Interest and other expenses attributable to the liabilities of the disposal groups continue to be recognized. Obviously, let's say I have a disposal group, in that there's a liability, there's a loan. Okay, now because that particular disposal group is being classified as held for sale, I can't tell that I'll not pay the interest for the loan because it is being classified as held for sale. No. So the expenses, the interest will still continue. Whichever is attributable to that liability of that particular disposal group will still continue, is what the standard says. Right? And there are some scoped out non-current assets, right? We say non-current assets. Now this standard, if you see, if it is applicable to all the non-current assets except these ones, it is not applicable to deferred tax assets, employee benefit expenses, financial assets, and biological assets, which are covered under 41, right? So it is the standards applicability, if you see broadly, applicable to all non-current assets except this. Deferred tax, it is not applicable. Employee benefit expenses not applicable. Financial assets not applicable. And biological assets, it is not applicable, right? Now next, some important note for measurement of disposal group. Remember that disposal group can include scoped out non-current assets. Obviously, like these ones can also be included, scoped out non-current assets, scoped in non-current assets, scoped out non-current assets, current assets and current liabilities. The measurement provision will apply to the disposal group as a whole. Of course, the measurement provision will apply to the group as a whole, right? On classification date, if it will be measured at lower of carrying amount or fair value less cost to sell. In case the fair value less cost to sell is lower than the carrying amount, obviously you have to book the loss, right? Now this loss, how will you distribute? The standard says first, in case there's a loss, like for that disposal group, let's say there's a loss, right? Then if there's a goodwill sitting in that book, if there's a goodwill sitting, then obviously when you have a loss, how can there be a goodwill? So first that loss, let's say you have a loss of 500 and you have a goodwill of 250. If you have a loss of 500, how come the goodwill is existing? There's no goodwill practically. So the standard says first take this 500, adjust this with the goodwill. Adjust this with that goodwill amount. And now even after adjusting, let's say I have adjusted 250. How much is balance? 250 still is balanced, right? Standard says for that, the remaining loss, what you do is you allocate it to the scoped in non-current assets. Whatever is the non-current assets that are scoped in. Scoped out non-current assets not to be included, current assets not to be included. So whatever is the scoped in non-current asset, you adjust with that proportionately. You adjust with the carrying amount proportionately, right? So this is what the standard says. I hope this you will get a couple of illustrations in your ICI module also with this principle, right? With this principle. So it is very easy. First, it says in case you see a loss, okay, that is your fair value is less than your carrying amount. Fair value less cost to sell is less than your carrying amount. Whatever, first that loss, you need to adjust it with your goodwill. And even then, if the loss exists, like even after adjusting with goodwill, the loss still exists, means then do nothing. You go to the scoped in non-current assets and adjust with the scoped in non-current assets in the proportion of their carrying amount. In the proportion of their carrying amount is what the standard says, right? Next is, if there is a change to a plan to sell, there was a plan to sell that asset, right? So that's why you classified it under 105. But now there's a change in plan. If the entity ceases the classification of non-current asset or disposal group as held for sale, you will measure. Now it will move from 105 to the respective standard 1640 or whatever is the respective standard. So now you have to reclassify that. Reclassify which value? For that, the standard says measure it at lower of carrying amount before classified as held for sale. Before it was classified as held for sale, there will be a carrying amount, right? Take that carrying amount and let's say it was let's say held for sale for a period of, it was for held for sale for a period of, let's say 1 year. So let's say 12 months. So for 12 months, you wouldn't have charged depreciation, right? You wouldn't have charged depreciation. So charge that depreciation, that revaluation in case any, take that also into consideration and bring it to its present value now. So what does the standard say? In case you are going to change your plan of that asset, now it is going to be, you do not have any other intentions of selling it anymore, so you're going to reclassify that. So when you reclassify, at which value should I take it to 16? If I'm taking it under in there 16, which value? So for that, the standard says measure it at lower of carrying amount before it was classified as held for sale. Before it was classified as held for sale, let's say on 1st April, the amount was 5 lakhs. So the standard says take this 5 lakhs and let's say you decide to do this on 31st March. So the standard says on 31st March or any other date, 9 months, whatever is the date. Okay, 9 months you want to do it, whatever it is. Standard says from 1st April to that particular date when you're deciding it to not classified as held for sale, that period ka depreciation also needs to be adjusted with this 5 lakhs. In case there's revaluation, that also should be taken into consideration, and that amount should be compared with the recoverable amount on the date of change of plan. Today on December, let's say 31st December, I'm deciding to change it. So on 31st December, what is the recoverable amount that will be compared with the carry that was on 1st April, that is 5 lakh, adjusted for depreciation for this particular 9 months, and compare both of them. Whichever is lower will be taken into consideration. Whichever is lower will be taken into consideration. Yeah, I hope it's very clear. It's quite an easy standard and very much understandable. And once you're very clear with non-current assets held for sale, discontinued operations is also relatively very, very small, right? Next comes the presentation and disclosure of non-current assets or disposal groups for which are held for sale. First is you will show the assets and the liabilities of those disposal groups separately, but you should not offset the assets with the liabilities. That is very important, right? You cannot offset the assets with the liabilities. You need to show them separately. And you will obviously, since you are following the index you are following, you will obviously show the comparatives also, correct? So when you show the comparative amount for prior period should not be reclassified. If let's say prior period if it was in 16, it should remain at 16. Do not in that comparative go and change it to 105. Do not do that. right? So the standard says first is you will show the assets and liabilities of these disposal groups separately, and you are not supposed to offset them. And also when you present your comparatives, comparative amount for prior periods are not reclassified. If it was that time 16, then you are deciding to sell it, so it will come under 105. So do not go to your comparative also and change it to 105. Do not do that, right? Do not reclassify it in your comparatives, is what the standard says. And the disclosure requirements for this non-current assets held for sale are nothing but you have to describe the description of the non-current asset needs to be given, the description of facts and circumstances of sale, who is it being sold to, and all such description of the sale details needs to be given. If any gain or loss is recognized during this transaction, that needs to be disclosed. If there's any change in the plan to sell, then the description of the facts and circumstances, why was the change, and all of that also needs to be mentioned. So that's all about the disclosure requirements. That's all about the disclosure requirements. Next come the definition of discontinued operation. Now non-current assets held for sale part is over. We are moving to the part 2, that is discontinued operations. Discontinued operations. Now what do you mean by discontinued operation? The standard says it is the component of an entity, an entity's component which is disposed of or classified as held for sale. It's a component of an entity which is being classified. It's either disposed of or classified as held for sale. So when I mean discontinued operation, it is a little broader term, because let's say it includes like a major line, or let's say geographical. Let's say you are a pan-India entity. So let's say you're planning to, only sell off your eastern region entities, eastern region group. So entire geographically, when you are trying to do it, geographical area of operation. Let's say east was my one geographical area operation. I'm planning to dispose that off. So it's much wider. So discontinued operation is a component of an entity, okay, which is being either disposed of or it is being classified as held for sale. It represents a separate line of business. Let's say I have 3 lines of business. I was into retail, I was into manufacturing, and I was into textile retail business also. I was into retail of FMCG also. So I decided I want to, dispose of my textile retail business because it's having a huge competition. So I do not want to compete in that forum, right? So what do I do? So here, what am I disposing? My major line is being disposed. My major line is being disposed, right? So it will come under discontinued operations. Or you are disposing a subsidiary that was acquired exclusively for the purpose of sale. Any subsidiary that was acquired exclusively for the purpose of sale. So in case these are there, then it will be considered as discontinued operations. If you're planning to dispose of either your subsidiary which was exclusively purchased with an intention to sell, if your major line you are planning to dispose that, or you're planning to sell it in the near future, or geographical operations wise you're planning to classify an area, then it will come under discontinued operations. For that, the standard says very simple. Only one principle is there. One is the presentation in the P&L, right? In the P&L, the standard says you will present it as a single amount in the P&L comprising of the total of what? Post-tax P&L of this discontinued operation. Post-tax P&L profit or loss of that particular, it should not be P&L, post-tax profit or loss. Profit or loss of that discontinued operations, right? So that's what the standard says. The presentation will present it as a single amount, right? Also disclose the income from the continuing operation and discontinued operations attribute to the owners of the parent, either in the notes or in statement of P&L. Obviously, this is for better comparison, so that the owner will know how much is your income that is going to be coming from your continuing operation, because that will come in the subsequent financial year also, right? But the discontinued operation will not come. So the owner or the stakeholders will be able to better compare the financials. So that is why they are telling separately disclose the income from the continued and discontinued operations. Next is change in plan of disposal groups. In case change in plan of discontinued operations. In case you're changing here also, like in non-current assets held for sale or disposal group also, there was an option. You are first classifying it under 105, then you change your mind. You do not want to sell it. Similar thing can happen for discontinued operation also. So the standard says in case the entity ceases the classification of discontinued operation as held for sale, then included in income from continuing operation, it will be included in income from continuing operation, and prior period figures will also be represented. The prior period figures will also be represented. Right. The other two little important points are that if the discontinued operation is abandoned, then the disclosure regarding the discontinued operation should be presented, right? Then the disclosure must be done for the same, and the EPS, earning per share of the discontinued operation, will be separately disclosed. It will be separately disclosed, right? So this was a comparatively very, very small standard, right? It mostly has simple principles. and some presentation and disclosure in the notes are the major parts of the standard, which I have discussed in detail, right? So that was all about the revision of IND 105. And we really we recommend that once you're done watching this revision series, you go and try solving your ISM problems, which will give you a lot of confidence and control over the entire standard. Thank you so much.